In this video, we're going to answer one of the most frequently asked questions that I get, and that is, how much life insurance should I buy? So not only are we going to answer that, but actually stay tuned to the end, and we're going to give you a couple bonus tips on not only how much should you buy, but what kind. What is going on? My name is Mike, and welcome to another video. If this is your first time here and you want the best financial education from someone who actually does this stuff for a living, start now by subscribing and clicking on the bell to make sure you don't miss out on anything. So when we ask the question, how much life insurance should I buy? The answer is actually pretty simple on one hand, in that the answer is, it depends. It's a little bit more complicated when we figure out what it depends on. And that is to say that very rarely do I meet somebody whose only goal is to actually buy life insurance. What's far more common is to meet people whose goal is something that life insurance is a means to. It turns out there's 5 very common goals that we come across when people want to buy life insurance: burial expenses, mortgage protection, income replacement, long-term care, and legacy planning. Now, each of these, because they're very different goals, is going to need a different death benefit amount. And what I commonly see for something like burial expenses is if you're older, in the ballpark of $25,000. That's because the common funeral is going to cost $20,000 to $25,000, and it's an incredibly common thing for the beneficiaries to simply assign their life insurance policy to a funeral home. And lo and behold, the expense of the funeral adds up to the total amount that's in the death benefit for the life insurance policy. But if you're younger and there's tons of time between when you expect to pass away, what I'm recommending for a lot of folks is in the ballpark of $100,000. Now, mortgage protection is pretty simple. Mortgage protection is simply the amount of the mortgage that you have and the length of time that you have on that mortgage. So if you have $200,000 owed and it's on a note with 20 years left, then you're going to get a 20-year term policy with $200,000 death benefit. And that ensures that when you pass away, your beneficiaries will end up with enough to cover the cost of the mortgage, so that that's at least one expense that they don't have to worry about. Now, income replacement is pretty similar in concept to the mortgage protection plan, and that is to say that instead of the amount of the mortgage, going to use your salary as the multiplier, and then it's the length of time until retirement. So similar to variables there to mortgage protection, but with income replacement, you're actually looking to replace your income for a period of time. Now, why do we target retirement? Well, the answer is quite simple. At that point, you're self-insured. If we've been doing our job and saving/investing towards retirement all the working years that you have, then by the time you retire, you've already replaced that income, and you don't need insurance to cover that. Now, you could still pay for insurance for that purpose, but that's just kind of wasting money. And if you like to waste money, well, you might as well call the British lizard, right? Okay, so long-term care. Most people don't think of long-term care when it comes to life insurance, and that's natural. Most people don't even think about long-term care until they have an ailing parent who enters a long-term care facility, and then it's about all they can think of. Well, most people don't like long-term care insurance because it's a pure expense. If you use it, well, then you're thankful it's there. If you don't, then you've essentially just thrown that money away. And remember, if you like throwing money away, you can call the British lizard. But for those who don't want to waste their money on pure insurance that they may never end up using, you can use life insurance to cover long-term care needs. And in this case, you're going to take the expected expense of long-term care, which can be up to $10,000 a month, and you're going to multiply it by the number of years that either men or women tend to use long-term care for. So in this case, for women, it's 4 years. For men, it's 2 years. Why is that? I don't make the rules. That's just how it works out. So if you're a guy, then you're going to want $240,000 of death benefit to cover 2 years of $10,000 a month withdrawals. And that's done by a rider you place on the policy that allows you to accelerate the death benefit during your lifetime tax-free for the purposes of long-term care. And you want to make sure that there's enough death benefit to cover that need. For women, it's 4 years times $10,000 a month, which is $480,000. And that's really a minimum. You can go higher than that because, again, inflation will likely make that care more expensive over the years. So that's really just a minimum. Now, legacy giving, you can do any amount you want, and you can give it to whomever you want. So either children or a public nonprofit, a private nonprofit. These are all options that you have, and you can give a portion or all of a policy to any of these people. But now, as I mentioned, we're going to also give you a bit of a bonus tip, and that is to say not only how much life insurance do you need for each specific goal, but what kind of insurance do you want for each specific goal? And the reason is some of them you can get rid of. Some of them you want to keep until you die. And the point here is with something like burial expenses, you need to make sure that that's available for you when you pass away. Otherwise, it doesn't do your beneficiaries a lick of good if you had a 10-year term policy and you died 30 years from now. So it has to be a permanent policy, which of course is more expensive than a term insurance policy. Now, mortgage protection, on the other hand, you know that there's a definite date after which you do not need the life insurance. So a term policy is entirely reasonable. It's the same thing with income replacement. When you are looking to insure the period of time before you retire, once you've retired, you can let that policy go. Unlike long-term care, you do not know when you're going to have need of long-term care. And so as a result, that policy has to be enforced throughout the rest of your lifetime. So having a permanent policy is the best way to ensure that that's going to be there. It's the same thing with legacy giving. You need a permanent policy to ensure that your wishes after you pass are honored for whatever legacy you want to leave. If it's the zoo, if it's a hospital, if it's a school, or your children. Nothing creates generational wealth better than life insurance. Now, you've probably got some more questions than I was able to answer in this video, and that's fine. I've got more videos for you that will dive a little bit deeper, so stay tuned.